This is Chapter 21 of Accounting 202, Flexible Budgets and Standard Costs. I will be reviewing the highlighted learning objectives. Managers use budgets to control their operations and make sure their planned objectives are met. Budget reports compare budgeted results to actual results. A master budget is based on a predicted level of activity, such as sales volume, for the budget period. In preparing a master budget, two alternative approaches can be used: a fixed budget or a flexible budget. A fixed budget or a static budget is based on a single predicted level of activity, whereas a flexible budget, called a variable budget, is based on several different amounts of sales. So we will concentrate on flexible budgets. Next, we'll look at preparing a flexible budget. The total variable cost will change in direct proportion to a change in activity level. Remember that the fixed costs remain unchanged regardless of changes in the level of activity, as long as we stay within the relevant range. So in a flexible budget, each variable cost is expressed as either a constant dollar amount per unit or a constant percentage of sales dollars. Fixed costs are expressed as a total amount because they do not change. So here's an example. To prepare the flexible budget, you will identify the activity level, such as units produced or sold, identify the cost and classify them as either fixed or variable, and then compute the budgeted sales, which is the sales price per unit times the number of units sold, and subtract the sum of the budgeted variable cost plus the budgeted fixed cost. The formula for the total budgeted cost management can compute at any activity level using a flexible budget. So we will simply prepare multiple budgets based on various sales activity levels. In this example, we are looking at three budgets, one prepared for 10,000 units, one prepared for 12,000 units, and one prepared for 14,000 units. Notice also that the costs are separated into variable and fixed. So first, we will express the variable cost in per unit amounts. And we will do this for the three different activity levels. Sales are budgeted to equal 100,000, which is computed as $10 per unit times 10,000. So in the first flexible budget column of 10,000 units, we can see we have sales of $100,000. Then we'll do this for all of the variable costs as well. The direct materials are $1 per unit, so multiplying 10,000 times $1 gives us 10,000 in cost for direct materials. And then following over to the 12,000 column, $1 times 12,000 is $12,000. So you will follow this for each of the variable costs. Then for the fixed cost, we know the fixed costs are a constant amount. So the amount you see for the 10,000, 12,000, and 14,000 levels will all be the same numbers. A flexible budget performance report will compare the actual with the budgeted based on the actual sales volume. So now we've found out that SoCell has actual results of 12,000 units. So we're going to look at the flexible budget based on 12,000 units, and then we can compute the variances. So you can see the sales variance is $5,000 favorable because the actual results of 125,000 is greater than the flexible budget at 120,000 units. Then we'll do the same computations for all of the remaining cost. So for variable cost, Looking at the direct materials, actual result was 1,000 higher than the flexible budget. So they spent 13,000, but the budget was 12,000. So that is an unfavorable variance. And then following down, you will do the same computation for each of the variable and the fixed cost. The only fixed cost that was different from actual was for the insurance expense. So their insurance must have gone up by $200. So then you can compute the variances for the contribution margin and then finally for the income from operations. So they did end up with a $3,000 favorable variance for their income from operations. Next, we're going to look at standard cost. Standard costs are preset costs for delivering a product under normal conditions. We can think of standard cost as budgeting on a per unit basis. When actual costs vary from the standard, management needs to identify and follow up and take corrective action. An ideal standard is based on 100% efficiency. A practical standard is based on normal operating conditions, and it does allow for some inefficiency. Direct materials standards are based on the final delivered cost of materials and include standard quantities at the amount needed to make the production. The standard material cost for a unit of product is the standard price for one unit multiplied by the standard quantity of materials required. And then we also use something called rate and time studies to look at the standard cost for labor. Labor rates are determined by wage surveys. Time standards are developed so that we know how long it takes to make each product. The standard labor cost for a unit is the standard rate for 1 hour of direct labor multiplied by the standard amount of time required to produce that unit. The rate standard for variable overhead is the variable portion of the predetermined overhead rate. The activity standard is the number of units in the base used to apply the predetermined overhead. So examples would be direct labor hours or machine hours. The standard variable overhead cost for a unit is the standard variable overhead rate multiplied by the number of units of activity. This is a cost standard which includes direct materials, direct labor, and overhead to produce one bat. In the first column, we see a standard quantity. Direct materials is expressed in terms of kilograms, direct labor in hours, and manufacturing overhead also in hours. In the second column, we have the standard price or standard rate. And then finally, in the last column, we have the standard cost per unit. So multiply the standard quantity times the standard cost per unit. Next, we will look at cost variances. The difference between the actual cost and the standard cost is called the standard cost variance. Cost variances can be favorable or unfavorable. If the actual costs are less than the standard, the variance is favorable, and if the actual costs are greater than the standard, the variance is unfavorable. Cost variance is computed as actual cost minus standard cost. Then we separate the cost variance into its components. Actual quantity, or AQ, is the actual amount of material or labor used. Standard quantity, or SQ, is the standard amount of input for the actual quantity of output. We'll look at examples. Actual price, or AP, is the actual price paid, and standard price, or SP, is the standard price. Price variances result when we pay an actual price that is different from the standard, and a quantity variance occurs when the actual amount of a resource differs from the standard amount that should have been used. When we're looking at materials and labor variances, the difference between the actual price per unit of input and the standard price per unit of input is the price or rate variance. And the difference between the actual quantity of input used and the standard quantity of input that should have been used results in a quantity or efficiency variance. This is the general model for computing materials and labor variances. We multiply the actual quantity times the actual price and compare that to the actual quantity times the standard price. The difference is the price variance. Then we compare the actual quantity times the standard price to the standard quantity at standard price, and that difference is called a quantity variance. The standard quantity is the standard quantity for one unit multiplied by the number of units produced. It is the amount of the resource that should have been used given the actual amount of units produced. The standard price is the amount that we should have paid. So we will look at examples now of materials and labor variances. We show how to compute the direct materials and direct labor variances using data from GMAX, who manufactures golf equipment. GMAX set the following standard quantities and costs for materials and labor for 1 unit of product. The direct materials standard allows 1/2 a pound per club head at $20 a pound, and the labor allows 1 hour per club head at $16 per hour. During the month of May, GMAX made 4,000 club heads. It actually produced only 3,500 units. So first we'll look at the materials variance. During May, GMAX budgeted to produce 4,000 units, but it only produced 3,500. It used 1,800 pounds of material costing $21 per pound. To produce 3,500 club heads, GMAX should have used 1,700 pounds of material, which is 3,500 units times 1/2 a pound for each unit. This amount of 1,750 pounds is the standard quantity for the actual units produced. So here are the variances. The total actual price paid was $37,800. So they paid $21 per pound. They should have paid $20. So therefore, they will have an unfavorable price variance. And they used 1,800 pounds of material, which is 50 pounds more than they should have because they made 3,500 units. 3,500 times 1/2 a pound per unit is 1,750 is what they should have used. They used 1,800. So they have an unfavorable quantity variance of 1,000. And then adding together the two unfavorable variances means we have a total direct materials variance of 2,800 unfavorable. Let's look at the labor variances. So for labor, we use the term rate and efficiency variances. The standard rate is the amount we should pay per hour for the work performed. Standard hours are the hours that should have been worked to make the actual output. And just like with material, we can reduce the relationship to these mathematical equations. So we'll look at actual hours times actual rate, and then actual hours times standard rate, and then finally standard hours times standard rate. We'll get the differences to get the rate and efficiency variances. So here are the numbers we're going to use. We're looking at direct labor. It should take 1 hour per unit at $16 per hour. So here we're computing the rate and efficiency variance. The rate variance is unfavorable because the standard was 16 and they actually paid $16.50. And then the efficiency variance is favorable because they should have worked 3,500 hours, but they were able to complete 3,500 units in only 3,400 hours. So now we have an unfavorable rate variance and a favorable efficiency variance. Since the variances are different, meaning unfavorable and favorable, we have to subtract, and the one that's the highest is what the end result will be. So the 1,700 unfavorable rate variance is greater than the 1,600 favorable efficiency variance. So the total cost variance is also unfavorable for the difference. So next we'll look at overhead variances. So you'll recall from previous chapters that we compute a predetermined overhead rate by dividing the estimated overhead costs for the period by the estimated activity for the period. So then we'll use the predetermined rate to assign overhead costs to work in process. The standard overhead costs are the overhead amounts expected to occur at a certain activity level. So you know that overhead costs include both fixed and variable costs. So management needs to separate out the fixed and variable cost. The predetermined overhead rate also contains a fixed and variable component. So to allocate the overhead cost to the products, management needs to establish the standard overhead cost using the three-step process shown here. First, determine the allocation base, so some unit of measure such as labor hours. Choose a predicted activity level. We will not use 100% because it's unlikely we can operate at 100% capacity, so something under that. And then we will compute the standard overhead rate, which will equal the total overhead cost at the predicted activity level divided by the total direct labor hours at that level. So here you can see the flexible overhead budget based on various levels of capacity, including 70, 80, 90, and 100%. So the company needs to decide which of these would be the predicted level. And you can also see that it's separated into a variable component based on the number of units. So it's $1 per unit, and a fixed component, which is $4,000. So here they've decided that 80% is the predicted level of activity. So now we can just look at this column, the 80% column, and we can get the standard overhead rate of $2 per hour by taking the $8,000 and dividing it by 4,000 direct labor hours. So this is how overhead is applied. So to compute the overhead cost variances, we will look at the difference between the total overhead applied and the total overhead actually incurred. And this is called the overhead cost variance. So the actual minus the standard. And remember, the standard is based on 1 direct labor hour per unit times the $2 per direct labor hour. So if they made 3,500 units, they're going to multiply that by 1 direct labor hour times $2 per direct labor hour to get 7,000. So now we can compute the total overhead cost variance, which is the actual cost incurred, comes to 7,650 minus the standard, which we just computed as 7,000. So they paid more than the standard, so this is a $650 unfavorable cost variance. We can also look at a volume variance, which occurs when the company operates at a capacity different from that which was predicted. So the bottom portion shows the volume variance, which is the budgeted fixed overhead, and that was $4,000, versus the applied fixed overhead based on number of units produced, 3,500 direct labor hours times $1 per direct labor hour. So the volume variance is unfavorable. And the reason it's unfavorable is because they made fewer units than they expected. They were expecting to make 4,000 and they only made 3,500. This concludes the recorded lecture for Chapter 21.